Good morning. This is Rick Hough. I'm Chairman and CEO of Silvercrest Asset Management. Welcome once again to our podcast. I'm talking today with Robert Teeter, Chief Strategist at the firm and head of our Investment Policy and Strategy Group. It is Monday, April 7th, and Rob, the markets are massively volatile. It started at the end of last week with the new Trump tariffs that have been announced. I want to talk briefly about what we see going forward. We're going to try to keep it simple. We're not going to pretend we know the future. So many people are telling us what's going to happen or what the policy is, and frankly, they don't know. And I think we have to admit we don't know either.
Right. Great point to jump off on. And there is an element that people should be aware of, which is every type of analysis or headline they see out there is obviously embedding some form of forecast as to what the future might hold for this policy. And I think that's a really important backdrop to keep in mind, that some folks are assuming current policy as announced last week will stay in place indefinitely. Some folks are noting that, of course, not all the policy has even been implemented yet, and there may be some further negotiation either between now and Wednesday or beyond that changes that.
Right.
So very important to understand what the underlying assumptions are when anyone's looking at a
So
forecast.
effectively, there's the policy. What is it? And we don't know all of it yet.
Right.
We have to admit that. 2, what is the effect
Right.
when you're forecasting? And then 3, what is the duration of that policy? We can't assume that as it is going to stay in place forever.
Right.
And what is the probability of that duration?
Yeah, I think that's the right way to look at it. The numbers are out there. We have some good information and understanding as to what the effect of those policies might be, and we can walk through some of the math.
Let's do some of that right now, very quickly.
Yeah, so just sort of big picture, rough numbers, raises the tariff rate in the U.S. to roughly 22%. And if you think about, the U.S. basically importing about 15% as in terms of size of economy, that puts you north of a 3% effect, which is basically suppressing growth.
So just to
increasing
keep it
inflation.
simple,
Yes.
22% tariffs.
Yes.
When you cut through everything, that's
Right.
the general effect.
Right.
15% imports in
Yes.
the economy.
Yes.
And if you multiply those effectively, that's the effect, and take 50%, you're at the 3% you were just talking about. Is that?
You're at
Is
the
that-
3%, and then
And then
you
50%.
take about half of that and get to something like a 1.5% reduction in economic growth and a 1.5% increase in inflation. And that's because the tariffs don't apply to everything. There are
Right.
some exemptions around U.S., Mexico, Canada. There's the issue of goods versus services, the number of different things going
Okay.
on. There's some adjustment effect, et cetera.
But what we see now, if it were to stay in place
Yep.
for what we know now, just assuming that nothing changes, negative 1.5% GDP effect, an increase in the consumer price index of positive 1.5%.
Yes.
That's net 0%.
on
right?
economic growth.
On economic growth.
Yeah.
And so that's where we are with what we know now. To keep
Correct.
things simple.
Correct.
How does that translate then into earnings for companies if that were to come to pass?
Yeah, so that's a pretty challenging scenario for equity earnings, at least on a look-forward year from this policy forward 4 quarters, let's say. So our work has shown that when you get below 1.5% growth in the economy, companies tend to anticipate recession. They tend to make cutbacks. It becomes a bit self-fulfilling. You throw in a lot of costs and restructurings, and you tend to get negative or at best flat earnings in that type of environment. So for argument's sake, let's say earnings stay flat versus last year. Policies aren't in place yet, so first quarter hasn't really been disrupted that much. Going forward, there may be some push and pull and things, offsetting and whatnot. But basically, we have an environment where you're pushing down growth from, let's say it's running at 2.5% now. I push that down 1.5 on the basis of how we model out the effect of tariffs. And that puts you at maybe 1% economic growth, which to us is sort of a flat to negative earnings backdrop.
And so the market's going to take that into account. It's already
Yes.
discounting it, hence all the volatility.
Correct.
In that environment, that would clearly push the market down further if it were to persist, and we'll see increased volatility for some time.
Yes.
For our investors. What does that mean in terms of a bad downside scenario for the market from here?
Right. So sort of very rough numbers. If we use last year's earnings estimate and assume earnings stay flat, And if we say that, PE ratios, which came into the year and
Price earnings,
rose,
right.
yes, to nearly 28 times earnings in mid-February, when there was a lot of enthusiasm
Very
around
high.
what was unfolding and expectations for a lot of positive things unfolding. We had been cautioning that the news had to come through in a positive way. Clearly, markets do not like how the news has come through. And so multiples, PE multiples, price earnings multiples have adjusted downward. We're now at about 21 times earnings based on trailing earnings. And if we think back historically, sort of typically in a correction in more recent years, you get down to 15 or so. It used to be, rule of thumb was that the long-term average was 16, and you could go quite a bit lower. So if you're talking sort of average crisis in more recent history, the last 30, 40 years, that gets you to a point where, let's say, multiples come down to 16, 17.
Times
that
earnings.
puts you in, that puts you in another, call it 15% decline from here. And when I say from here, from last Friday, markets have been both down 5 and up 3 at various points today.
Right. The last time we spoke, you noted the market was up year over year,
Yes.
despite this decline.
Yep.
And at least to that point, declines of that nature are actually quite frequent in the markets. Like on average, every 1 to 2 years, people forget that happens. We're still sitting on pretty incredible gains the past 3 years or so.
Yes.
What does another 15% leg down in the market do?
Yeah, it's obviously painful, and no
Sure.
one wants to encounter that. And I think the updated numbers over the past year, down about 2.5% through the close on Friday. So it would bring numbers down pretty considerably. But it's important to look beyond that as well, because we have an important question here again of how long will these policies stay in place, and what does that look like? So the modeling around getting to flat earnings and down 15% and no economic growth, all is sort of built on an assumption that these tariff policies stay in place
That nothing
for a
changes.
long time and nothing changes from here.
Okay.
A more optimistic scenario might be, are we at peak tariff right now, and tariff policy starts to evolve and change going forward in a way that markets see as more favorable.
And there are two possibilities for that, I think, on the upside. One would be the actions of Congress.
Yes.
Or midterms.
Yep.
I think the problem with that is Congress could act potentially, but midterms is a long way away.
Yes.
The second would be actual changes in the policy due to deals, negotiations with countries to get to more fair trade practices. Obviously, the second scenario is a lot better. What do you see as the prospects for that?
Yeah, that seems to be what the market's struggling with here. Is the administration really digging in their heels and not changing at all, or will there be deals? And we've seen communications of both. So just as we
We're
outlined,
getting mixed messages is the problem.
Just like with the original policy, where we noted there was reciprocal and kind of implying negotiation, but also a focus on trade deficit. We're still seeing some of the same mixed messaging of, no changes, we're dealing with the deficit, this is the policy that's in place, but also lots of leaks and other commentary around, well, we've talked to lots of different countries and we're negotiating deals, and there could be, great deals to come. So it's hard to set probabilities on those two things, and particularly over what timeline you think they will occur. But I think it's equally hard to dig yourself into a very bearish or dour outlook and assume that, a policy that's received by markets very poorly will stay in place for a long time. It seems to be that the administration in the past has proven to be at least somewhat receptive to how markets are viewing things, not the least of which there is a real wealth effect, there's a real sentiment effect, there's a real business investment effect if markets keep declining.
Right. We try not to get political. We have to judge the world as it is, right? That's really important for investors to remain objective and see where it is. And I think when we last spoke, we were both a little more optimistic that this was about setting a hard line to negotiate deals. Right. I think we both still hope that is where it's going, but the rhetoric has been more about let's just reduce this trade deficit period and take in revenue from tariffs. So that's part of the mixed messaging and the change that we're now seeing. And objectively, we, I think, are both looking at this and thinking, okay, there's a real negative downside now, given how things are positioned. And so we're just trying to understand what is the room for maneuvering whereby the policy, such as it is, won't last and have even more of a negative effect. Would you say that's correct?
Yeah, absolutely. And that's why we really do emphasize sort of having this long-term plan and sticking to it and not responding to each and every news release that comes out every 5 minutes during the day. And today's a perfect example. Again, the futures were down almost 5% at one point. At another point in the day, equities were up 3%. So trying to trade against that backdrop and day trade things is really not something that anyone can succeed at. And so it's important to have a plan and recognize that plan's intended to carry you through these times of
You
volatility.
have a plan for a reason.
Yes, exactly.
Right.
Exactly.
And trying to second guess it in the midst of this unknowable market.
Yes.
Information of the future is almost always unknowable.
Yep.
Can do some real damage.
Exactly.
Thank you, Rob.
Thanks, Rick.